The foreign bank account report, the famous FBAR for short, is not a new form. If you can read the slide, you'll see that it was enacted as part of the Money Laundering Act of 1970. The FBAR is 45 years old, so it's certainly not a new tax form. Now, for most of you, you never heard of it before. Well, it's not a tax filing form. There's no tax associated with a foreign bank account report. It is a report of defined financial assets and accounts held outside the United States. That's important. If you have a bank account in the United States, it is not a foreign bank account. If you have a mutual fund in the United States, it's not a foreign bank account. If you have a mutual fund in Greece, it is a foreign bank account. So, anything outside of the United States is a foreign account. Okay? So, we start with the premise that it is only for foreign bank accounts. And remember, this is a U.S. law, so it relates to anything outside the United States. Actually, enforcement was minimal. In fact, I would say it was non-existent until 2009. In fact, if you were to go onto the IRS website in 2009 and you were to search for the big publication 54, which is the Bible for the annual filing by U.S. tax residents abroad, you would have found no mention of FBAR. So it's no wonder that it's sort of a late bloomer, as it were. Who must file? All U.S. citizens, legal permanent residents, any trusts, any estates, and U.S. domestic legal entities. The persons and entities listed on the prior slide have to file if they have a financial account located outside the United States and the total on deposit in all such accounts at any time during a calendar year exceeds $10,000, or roughly 8,800 euros, they have to report. I want to repeat those critical facts. It does not mean that you only report accounts that have more than $10,000. Right? That's not what the rule is. The rule is if you have one account with 4,000 and one account with 4,500, you have 8,500 euros on deposit. When you convert that to USD using the official US use that on the official rate, you've got 8,500 euros. You have to report both accounts. If you have one account with 500 and another account with 5,000 and another with 3,500, you add them all up, 9,500 euros, you have to report all three accounts. And this is the high balance. This isn't the year-end balance. Right? It's the high balance at any time during the year. Exceeds this number. Now I'll make my first commentary. This is a stupid law, and it's a stupid form. Right? It's a totally stupid form. It is useless. It's not a wealth statement. It's not an inventory of your assets. It's a totally stupid form. Which form? The FBAR. So why does it exist? Why does it exist? It exists because it was enacted in order to get around bank secrecy laws in 1970. So at the time, you can imagine somebody having accounts outside the United States in 1970 was a bit unusual. It didn't take into account the fact that there are now probably close to 10 million U.S. citizens living outside the United States. So I say it's a stupid form, but respect the form because the penalties for not filing it are awful. I want to underline those words, awful. If you simply ignore it because you think it's stupid or annoying, and it is going to be very difficult to get through all of this, and a pain. It'll be a pain. In any part of the anatomy you want to name, it's going to be a pain. But do it. All right. Now, the FBAR includes financial accounts over which a U.S. citizen has signature authority, even if the person has no beneficial interest in the account. And that includes an account of a company for which a person works. So I'm a senior vice president of ABC company here in Greece, and I'm the CFO, and I'm expected to sign checks and do other things, and I happen to be a U.S. citizen. I have to report those accounts on my FBAR. They're in Part 4. Don't shoot the messenger. The FBAR regulations make it clear, all right, that even if the U.S. person is not an owner of record, if the owner of record is that person's agent, or the U.S. person can control the account directly or indirectly, that person has signature authority. You may say, well, gee, my mom's got the account, not got my name on it, but anytime I ask her to take out $10,000, she takes it out and gives it to me. That's your account and has to be reported. Foreign financial accounts include bank, savings, checkings, and deposit accounts, and securities accounts. They include any account from which cash can be withdrawn regardless of what the bank calls it. Mutual funds and other funds in which a U.S. person has an equity interest, but stocks, bonds, and promissory notes are not foreign bank accounts. Now, each U.S. person must file his or her own FBAR. Married couples can only file a joint FBAR if all reportable accounts are jointly owned by them. So there can't be an account. One of the things that you do here in Greece that's very common practice is to have multiple members of a family on the same account. Sometimes it's mom and dad and daughter and son. Sometimes it's grandma, grandpa, daughter, grandchild. Sometimes it's aunt, uncle, and niece. Believe me, I've seen lots of these situations. If you are a named joint owner on a bank account, you must report that account. It's that simple. Even if the money, you say it's not mine. It's not my money. But your name is on the account, and I know the reason for that. Certainly with elderly parents, you want to be able to manage the account for them, to be able to go to the bank, take money out for them. And of course, the other reason is, should they die, you don't want to go through the estate tax. You simply want the money to flow to the next generation without tax. All of this is perfectly legitimate, right? But the rule is, if you are a legal joint owner of an account, irrespective of whose money morally is in the account, and whether you would ever touch it, it has to be reported on your FBAR. Now, strangely enough, we have clients as young as 3 and 4 who file FBARs because grandma has left 50,000 euros to each of them some years ago, and they have a joint account, grandma and little Yanni or Katerina, right? Well, Katerina's a U.S. citizen. She has 50,000 euros in a bank account. She reports an FBAR. I said it's a silly form, and it is. And you say to yourself, makes no sense. And I agree with you. It doesn't make any sense. But it's the law. And it won't be the first law that never made any sense. The problem is the consequences of not filing can be quite serious. The other thing you need to know is, unlike a tax return for which you can get an extension, the FinCEN, that's the name of the form now, we still all call it an FBAR, but the formal name of it is a FinCEN 114, has to be received by the IRS electronically on or before June 30th each year for the prior year. And there are no extensions. So it's very important, if you're going to do this on your own, to make sure that you have filed your FBAR electronically by the 30th of June. Filing it on the 1st of July, it's late. Now, FBARs are required to be filed every year. The statute of limitations on an unfiled FBAR is 6 years from when it should have been filed. Remember I said earlier a tax return has no statute of limitations if it's not filed? In the case of an FBAR, that's not the case. If you hadn't filed an FBAR for 2007, and I dare say everybody in the room did not file an FBAR in 2007, it is statute barred. The IRS can't do anything to you about that 2007 unfiled FBAR. So any compliance that you're considering should begin with 2008 or 9. I'll explain why it might be 8 or 9 in a minute. Here's the problem. The penalty for non-willful failure to, this is non-willful now, failure to file, is $10,000 per account per year, which is, think about it, if you had that 500 euro account and the 4,500 euro account and the 3,500 euro account and you hadn't reported it for 6 years, you might owe $30,000 a year, $180,000 in penalties for not having reported accounts worth less than $12,000. It's a stupid law, but it's still, that is what it is. No penalty is owed if the failure was not willful. Notwithstanding the fact that the service refers to non-willful penalties, the fact of the matter is they do not apply those penalties. That's what the law says, but that's not how it's applied. No penalty is owed if the failure was not willful, and the taxpayer can establish reasonable cause, particularly if each account is properly reported. Now, willful means a voluntary and intentional violation of a known legal duty. Willfulness does not exist if a person had no knowledge of the FBAR filing requirement, and the burden of proof in the case of trying to establish willfulness is on the Internal Revenue Service. Now, the next couple of slides really aren't probably very relevant to you because I don't think anybody in the room has really been willfully hiding money from the U.S. government. But willfulness, if proved, can be pretty disastrous. It involves significant civil and criminal penalties. The civil penalty can be the greater of $100,000 or 50% of the high balance in each account for each year that an FBAR is not filed. And criminal penalties are even worse. Now, the reason that the IRS pulled this old statute off the books and started to enforce it was for the very reason of those penalties behind me. Because that was a real club to hold over the heads of those high net worth U.S. resident individuals who were using UBS and other numbered Swiss bank accounts to hide income from the United States and to evade U.S. taxation. And when the IRS learned through the whistleblower activity in late 2008 of the prevalence among certain people of using these illegal mechanisms, it was able to pull out these kind of penalties and threaten both civil and criminal penalties to those who didn't step forward voluntarily.